Thanks, Wayne, for joining us. First of all, congratulations on reaching EBITDA break-even, or even a bit above that. So the last year has been one of sort of cost-cutting, I guess, almost bootstrapping to get to that point. Does that mean, so now that you've reached that in terms of growth, there is a bit more room to invest in growth going forward?
Sure, and look, thanks. It's been a good 9 to 12 months, operating for the business. Cash burn has come down, almost 300% over the year. We're in a position where we don't require capital to raise to continue operating activities.
Yeah.
But we see, to answer your question, we see a huge amount of opportunity still within the current cost base to grow additional revenues and to grow organically. Right. So we will be investing some of the capital that we've got at bank just to things like services, our services offering. But it's a completely organic process. As we bring on new contracts and we can see more opportunity, we will bring those headcount on. But it's fairly minimal, to be honest. We have a view that there's still a lot more we can do organically without having to raise capital and using what we've got at bank.
Right. Okay. Well, that's good to hear. You also closed a large number of deals. I think in the last 6 months. For instance, Nando. Can you talk a little bit about the impact for you guys? Because Nando actually was initially a smaller contract and then extended or expanded, I guess is the better word. Can you talk about the impact for you guys in terms of sort of revenues, what it means to get these sorts of companies in? So revenue-wise, but also because these players are basically global, what it means for you in terms of reaching out into other geographies, maybe.
Look, I think we've made the point on a couple of calls before where we see opportunity across a fairly diverse spectrum of customers, and ranging from small customers like a Nando's, restaurant owners, even bars and so on are kind of in that remit. They are smaller revenue items on a per venue basis for us, but they require no changes to the platform, the technology, and it just provides additional reach, additional data points, and helps to complement that customer journey, if you understand what I mean. So understanding how people interact outside of just malls and airports is an important component in being able to retarget them eventually. So that's why those venues like Nando's are important to us. As I mentioned, the revenue impact is definitely less than a shopping centre, for example, but at scale, which is what this Nando's contract is, it does have a meaningful impact and can be sort of up there with some of our mid to larger customers. We converted the first contract with Nando's Australia, which was around about 200 venues here in Australia, and we've since extended that to some of their international markets, and I think we're up around 550 venues now under contract. So a meaningful portfolio, and we think there's probably additional room we can grow with that customer as well.
Right. And in these tenders, why do customers choose you guys? So what is important for them in that whole decision-making process?
Look, it's a great question, and it kind of varies depending on the client. Someone like a Nando's and those types of venues are really interested in just understanding, their store metrics, how people are visiting their store and how often. Most importantly, they want to understand who their customer is, and they want the opportunity to market to those people to try to drive additional visits in any kind of given period. So it's really more about the marketing, location-based marketing opportunity than anything else. The larger customers, it's more about behavior and physical operational insights that they use products like ours for. And look, to answer your question directly, the feedback we get is our technology supersedes the competition. The quality of the insight that we're producing just seems to be a lot stronger than our competitor set, and that's really the reason people come to us. I think it's also important to note that we're not just a software platform, and I think that's going a long way as well in terms of people feel comfortable that we've got the in-house capability to help them understand how to use the data through our services team, and that's a really clear differentiator. Yeah,
and so about the sort of the other revenue lines, so apart from the IO platform, you've got service revenues, so you've got data consultancy in there, marketing services, and also Causley, which you acquired in February, I think. Can you talk a little bit about how Causley is going? So versus your expectations, so the integration, cross-sell, how that is all sort of progressing.
Sure. So I'll answer the Causley question first and then come back to the various revenue lines. So Causley has been a fantastic acquisition for us in many ways. First and foremost, it's given us a referenceable US customer footprint, which has really helped our kind of visibility in the US being such a big market versus where we were before the acquisition. So that's job number one, which it's definitely ticked the box for. Number two is we've got a very significant profit contribution coming through from that business, which is obviously helping cash flow and helping to drive our business organically further forward. Our internal business case for Causley has been superseded every single month since February. Okay. So that gives you some idea in terms of how that business is performing. It's exceeded our expectations internally, which is a great thing. The cross-sell opportunity is fairly vast. We're learning about particularly the US QSR, quick service restaurant footprint, and Causley has a fairly large group of customers that we can cross-sell into there. But the big opportunity that I see is within the church vertical, in fact. And suffice to say that there's a number of progressed conversations there with a lot of the Causley customers in that vertical, and we should see some significant cross-sell there as well. Right. And that's really the kicker for us at the moment. Right.
Okay. And so talking about acquisitions. What else are you looking at in sort of the near to medium term? Because you've done a few ones. Causley is one, and before that you had Wycombe. So what can investors expect sort of in the next 12 to 18 months?
So look, the first job is we see a lot of opportunity to grow the business organically with what we have today, and that's we probably, I think I mentioned this on the last quarterly investor call. Most of our initial contracts with customers, they're buying 10 to 20% of what we can actually offer them. We start with, I guess, call it a basic package in terms of being able to deliver analytics or guest Wi-Fi or a marketing element. But we leave a lot of upsell within our current product, IO platform, but also within our services teams that we can upsell on. So, there are, every customer cycle, and typically it's a 3 or 5 year contract term for us. We've had 2 successive cycles now since we were founded. We've had no churn, and we typically are also re-signing those contracts for additional revenues on top. Platform hasn't changed other than our normal roadmap, which obviously we build on every 2 or 3 weeks. But ultimately they're buying more services from us, and so job number one is just to continue organically, and we don't require. We don't need to make acquisitions. But the good news is we're in a position now operationally where we don't need capital to continue to operate, which is unlike a lot of our competitors across the world. So we do see opportunities for us to go in and actually acquire customer contracts which are immediately accretive to us, and so we'll look at that for sure.
So is that the key driver, additional customer contracts, or could it be specific technology that some of your competitors have that you don't have, or something that would sit well with you guys?
Look, no, we don't believe we need to buy any technology, and I think technology could be quite a cumbersome integration process for us, and we're conscious of that. So it really is just pure footprint, customer contract footprint, which is a much easier acquisition for us because we don't, in most cases, need to bring over any significant overhead from those businesses. It purely rolls into the current offering and doesn't add any significant additional cost to the business, and we can immediately ramp an upsell on that footprint. So those are the ones we're looking for. They're out there, and we'll consider them as the time comes.
Is there a preference for location? Could it be US, Europe, or just anything that looks interesting?
Look, I think the preference ideally would be Europe or US for sure. They're just bigger markets. They're markets where we haven't got, albeit we're growing quickly in the markets, that we haven't got anywhere near the footprint that we do have in ANZ. But having said that, if there were ANZ opportunities, we'd look at them. But certainly, I think the real opportunity still exists over in Europe and the US.
Is Asia interesting from your sort of product offering?
Look, it is. Asia is one of those markets where, again, probably a bit like the US, we'd have to invest significant time in the market and add additional headcount to be able to deliver anything meaningful out there. But absolutely, it's I'd say it's on the radar, but it's lower down on the priority list than the others.
Right. So looking at a couple of years, what's the strategic direction for Skyfii? So you've been on this path for a while. Things are going well. Sort of looking out to that sort of 2-3 years, what are you thinking of? Any sort of additions to the business, or just in sort of broad terms, what are you looking at?
Yeah. Look, we feel as though we're starting to move down a path of being able to reward investors, particularly the ones that have been with us since day one, and it's really pleasing to be in the financial position we're in today as a business. Moving forward, first job is to continue to build our revenues organically, and we can see a significant opportunity to build on that, particularly into FY19. So we're on a really good track already for Q1 and so on. So that's job number one, is to flesh in particularly our services offering into a lot of our contracts where we see opportunity to do that. So first job is to do that. Second job is to continue to drive into particularly the US. Mm-hmm. So the UK has had a really good run in the last 12 months off the back of a couple of years of investment. The US should kick as well this year, and we're looking forward to driving some revenues there. And again, job number 3 is to consider opportunities for acquisition, but those are superseded by organic growth in the first instance.
Right. Okay. Well, Wayne, it sounds like things are going really well for you guys. So again, congrats with the EBITDA positive level. I think that makes a big difference, probably internally, but also externally. It's just how investors look at the company. Mm-hmm. I think that's really a great milestone. Thanks for being with us, and we hope to have you back soon.
Great. Well, Mark, thank you very much. Appreciate it.
Excellent.